All right. Today's Wednesday, the 30th of July. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And let's begin by saying happy FOMC day. We will talk about it in details, what Powell said, didn't say, and of course, the implications on rate cuts this year. On top of that, we're going to look at the earnings that we got from Microsoft and specifically Meta. I dug deep into Meta's earnings. The kind of information and coverage and the way I'm going to present it, you're not going to find it anywhere else. I challenge you to go to CNBC or Wall Street Journal or go to YouTube. You're not going to find anybody doing the Meta earnings analysis the way I'm going to do it. And without further ado, folks, let's dive right into it here, beginning with the FOMC. Today, of course, much awaited FOMC meeting, specifically in the heels of the meeting by Trump and Powell at the Federal Reserve about a week ago, and the confrontation that was absolutely comical. But the expectations heading into this meeting were pretty much clear that we're not going to get a rate cut. But the element of surprise came from the fact that we have two governors who dissented. Two governors, Bowman and Waller, I guess. They disagreed and said that we should be cutting rates right now. And that's the first time we've seen that since 1993. So, of course, they smell blood. They know that Powell is on his way out. Of course, they want to please the president and say, hey, I'm raising my arm here. Maybe you should pick me as the next Fed chair. I want rate cuts right now. That could be the case, but I think Powell is on the right path. There is no reason to cut rates when you have the unemployment rate not moving higher, when you have asset prices at all-time highs. There is no reason to cut. And on top of that, we have, of course, the tariff inflation. We're beginning to see some of that. And not to mention, of course, that we talked about this in details, that as the stock market goes higher, and hence the importance of Meta's earnings, because that was huge, and it says something about where we are in the AI bubble right now. But if the stock market is at all-time highs, the affluent consumer is going to do fine. The affluent consumer is going to feel okay to spend in the economy, and they do about 75% of the spending in the economy. And that's risky because if you cut rates, they might spend even more and create more and more inflation in the economy. Of course, at the same time, we have what I would call a shadow recession. Because I know, and you know, and everybody knows, that we have certain segments of the consumer, such as the lower income consumer, even now the middle class consumer, and maybe the lower, higher income consumer, are all falling into a recession. Their budgets are squeezed, they're drowned in debt, delinquency is rising, and of course we know what's going on with the housing market. So there is a shadow recession underneath it all, but it is masked by the performance of the stock market and the reflection of that by spending from the affluent consumer. It's a sad reality. It's not fair, but at the end of the day, if you want to begin to cut rates, you have to start by damaging the spending by the affluent consumer in the economy. And the only way to do that is to drop the stock market down. I mean, we've seen when the market earlier this year went down double digits. Immediately, we've seen sentiment change, and we've seen the affluent consumer, among many other classes of the consumer, changing their behavior and spending and reducing spending and being more protective and defensive. So we go back to the argument of, oh, the stock market is not the economy, which I disagree with. The stock market is the economy. That's the way they designed it. It was not supposed to be that way, but they designed it this way after the crash in 2008, 2009. Now, as I said, if you want to damage the spending by the affluent consumer in the economy, you have to drop the stock market down. And the question now becomes, what's leading the stock market higher? And the answer is, and you'll see in a minute when we look at Microsoft's and Meta's earnings, it's these large, big-cap technology companies who are continuing to generate billions of dollars worth of revenue and profits and spending billions of dollars in AI spending and whatnot. And that's keeping the stock market higher. The weight, the collective weight of these stocks. We're talking about Microsoft. We're talking about Meta. We're talking about NVIDIA. We're talking about AVGO, Broadcom. Maybe not so much Google, because that's a problem now, specifically that Meta, as you will see in a minute, set the bar way too high. And maybe not for the consumer-related big-cap technology companies such as Amazon and Apple. But the B2B spending by these big-cap technology companies is keeping the stock market higher. And it's going to be really interesting to see if we have contrast between the B2B segment of the AI, big cap, large stocks, large companies, such as Meta and Microsoft, against companies that are also big technology companies, but they have exposure to the consumer, B2C. That's, of course, Apple and Amazon. So interesting day ahead. But like I said, if you are the Fed chair, and you're not seeing a problem in the jobs market. And Powell talked about that in nauseam today. And you see the stock market at all-time highs. And you know that the affluent consumer spending, which about 75% of all spending in the economy, is heavily influenced by the performance of the stock market. As a Fed chairman, you can't cut rates. It doesn't make sense at all. Not to mention, of course, the tariff risk, which, again, we get more and more details every day. And today there was pretty much, in essence, the Trump administration saying that packages that were exempt under $800 or less, these were exempt from the tariffs. Now they're not going to be exempt from the tariffs anymore. So even the smaller items, the cheaper items that we import from all over the world, these are going to be subject to tariffs now, and that's going to bring inflation. So there's a lot of risk for the Fed chairman to cut rates just to do political favors at this point. And he's not going to do that. As a matter of fact, Powell was more hawkish than I anticipated. He even threw cold water in the September rate cut. And look at what happened right here. He absolutely killed the odds for a September rate cut. Look at the change that we got today. Going into the meeting, we had over 60% chance that the Federal Reserve is going to cut rates by September. After the meeting today, the probability went down to almost 40%, and the probability for keeping rates as is went higher to about 59% chance. So now the odds are in favor of no rate cuts in September. How about October? The rate cut is still intact, so we still have a probability of about 47-ish, 48%, which is decent, but still under 50%. But look at the change that we got in the probability that October might also see no rate cuts. The odds for that surged higher, closer to 40% right now. And maybe as we continue to get more and more data, we're not going to do an October rate cut either. Then you go to December, and we're still pricing in just one rate cut that's going to happen in the month of October. So if that's gone, no rate cuts for the year. And what does that really impact? Well, it impacts the consumer, because the consumer is still dealing with credit card debt and auto loans and mortgage rates and all of that, so it's going to damage the consumer. But this is the dynamic that we have in the economy right now. You can't cut rates for the reasons I stated before. At the same time, higher rates for longer, as we have right now, will cause damage among the consumer. And this is why I call it a shadow recession. Now, when it comes to the stock market, who's going to be the biggest casualty if we don't get rate cuts this year? It is the speculative names. It's the stuff that went significantly higher since the Liberation Day fiasco. The high beta names, the profitless names. If we're not getting rate cuts, they're going to come down hard. But they're not going to impact the bigger companies much, because you'll see in a minute here as we segue to earnings season. How about we do that? You will see that these companies, if you increase rates at this point, it wouldn't harm them, because the results that they produce are still solid. If you look at Microsoft, in a nutshell, we're looking at, in yellow, we have revenue growth. In red, we have operational income growth. And in green, we have Azure growth, which is the highest growth segment in Microsoft. I want to look at trends. And you can see that the trend for revenue growth has improved in Q2 25. That's the report that we got today. That is an improvement from 13.25% in Q1 25. And it's the highest rate of growth in revenue that we've seen in the last 4 quarters. Now, when you look at the operational income growth, the bottom line, I don't look at the net income because of taxation and all of that, so I look at the operational income. You can see that in the recent quarter, went up to about 23% rate of growth year on year, improving from about 16% rate of growth year on year in the previous quarter. And this is the highest reading we've seen in the last 4 quarters. So far, so good. There's nothing not to like here. How about Azure growth? 39%, which matches the rate of growth from the previous quarter. I don't see any problem with Microsoft's earnings. Now, what about the valuation, though? Isn't the stock a little bit too hot and went ahead of itself, and now it's moving higher again after hours? I don't look at the PE ratios, forward PE, all of that is garbage. I don't know who invented that, but it's just not accurate. I use the Maverick formula, which is the stock is trying to price in the rate of growth of the top and the bottom lines in a specific period of time. And if you see the stock performance, for example, exceeding the performance of the revenue and operational income growth, then we have a case of overvaluation. If we have a case where we see the stock performing under the rate of growth of revenue and operational income, then we have a case of undervaluation. So if we look at the first half of the year, that's combining Q2 and Q1, the revenue growth was up by 15.7%. The operational income growth was up by about 19.5%. The stock performance of Microsoft was up about 17%. So right around the sweet spot. So there's no problem here. It is pricing in the revenue and operational income growth. Now, if you look at the closing price of today, so we just looked at H1. Let's look at year to date now. And the stock growth is 20.61%. So it is overvalued already above the results that we see from revenue growth and operational income growth, but at the same time, the stock is trying to price in what's going to happen in Q3. But even with that, I think the stock went a little bit too hard here with the reaction that we've seen recently. On top of that, of course, the pop that we got after the bell. So I would say that Microsoft has a better chance of seeing profit taking in tomorrow's session. Now, when we look at Microsoft's reaction after the bell, we see that Microsoft is up about 8.25%, trading at about 555. Now, we've done a lotto ticket on it. I did 2 trades, one betting that Microsoft will have a flattish reaction, another one that's going to have a bigger reaction. And the trades at the end of the day balanced each other. The first one is the Iron Butterfly, and this one right here sold the 510 puts and the 510 calls for the expiration date of Friday, and then bought the 520 calls and the 500 puts. Those are the boundaries of the Iron Butterfly, and the goal from having these boundaries in this structure, what we call Iron Butterfly, is to stop the loss, because we sold the 510 calls and puts. What if there is an erratic move one way or the other? Where do you want to stop your loss? And we stopped it at 520, which is about $10, and we stopped it in the case of the puts at 500, which is about $10 too. Now, the credit that we've received from this trade is about $850. So the maximum loss, now knowing that Microsoft is way above 520, the maximum loss from here is about 150. But again, the risk versus reward was worth it when we entered this trade, because you're getting a credit of about 850. And we've seen a lot of flattish reactions. Given the fact that the maximum loss is tiny, about 150, why not take the shot? But just in case we see an erratic reaction, we want to participate in that too. So here's the second trade that I've done on Microsoft, and I shared this with you in the Lotto Tickets channel on my Discord. In this case, we've done a double calendar. We bought the 460 puts and the 550 calls for the expiration date of next week. We sold the same legs, the 460 puts and the 550 calls, but for the expiration date of this Friday. All in all, the cost was about 80 cents a piece. And which leg is relevant now, given the pop of about 8% or so on Microsoft? It is the call leg, of course. That's the one we're going to play. Now, the stock is trading at about 855, so if it closes like this, then we're not going to make money from this trade. But if we see a pullback profit taking, as I anticipate Microsoft, and maybe Microsoft settles at a gain of about 5% or so, then the 550 calls we sold for this week will expire worthless. And we're going to have the opportunity to play the 550 calls naked for next week. And we have plenty of options when we get there. We can open a spread on it. We can double down on it. We can roll it. We can do a lot of things with it. I'm going to let you know exactly what I'm going to do with it in Discord tomorrow. But let's talk about what I would describe as perhaps the best report I've seen in a long time from a company this size. I give it an A+. And usually I don't give A+. I give A- for a report that is pretty good. This one I'm giving A+, because I dug as deep as I can, trying to find a flaw in Meta's earnings, and couldn't find any. Let's begin the conversation, of course, with the main concern about Meta, which is the CapEx spending. As you can see here, we're going back to Q3 24 all the way to the most recent quarter, Q2 25. CapEx growth year on year is significant. In the most recent quarter, it went up by more than 100%, which is double what Meta was spending on CapEx last year. So that's problematic that they're spending too much, but again, it's an AI war. It is a bubble, and you have to survive here. You have to spend to be ahead of the competition. Now, what's relevant is you got to look at the CapEx to the revenue ratio. Okay, they're spending a ton of billions of dollars, up 100% year on year, but are they generating revenues to afford to do all of this CapEx? This is what the CapEx by revenue ratio is going to give you. So again, you're never going to find this kind of coverage on earnings for Meta anywhere. Not in the YouTube channels, not in the professional channels, not in even the firms that do analysis. They're just going to say, oh, beat earnings expectations, beat analysts, whatever. Who gives a shit? We're digging deep here. So when we look at the CapEx by revenue rate, you can see that the rate is increasing. So they're spending more and more of their revenue now on CapEx. In Q3 24, it was about 20%. In the most recent quarter, it's about 36%. But it's still not bad. It's not above 50, for example. They're not spending half of their revenue in CapEx. Maybe if we get to that point, it's going to be problematic. But right now, It seems that Meta is generating enough revenue to continue to increase capex. Okay, but Mav, this is huge spending. 36% of the revenue is going to capex. I'm betting that Meta is probably not making any profits. You'd be mistaken, my friend, because when we look at the revenue growth in white and then we look at the operational income growth in orange, you can see that revenue growth has been doing pretty good, and this is the highest reading, 21.6%. This is the highest reading going back in the last 4 quarters. When you look at operational income growth, it's not the highest reading, but it's an improvement over last quarter, which was about 27% rate of growth. Now we're higher at 37.25%. So they're making a lot of profits. And that's why the market is pleased with Meta. How do you do that? It sounds like sorcery, right? It sounds like they're spending, increasing capex by 100%, spending about 36% of the revenue in capex, but still making profits. Not only that, but the profits are increasing higher. What is the secret here? Let's look at the details of the cost segment in Meta. And here in white, you're going to see the cost of revenue. In orange, you'll see R&D spending. You got marketing in green, and you got G&A, general and administrative costs, in yellow. Notice that the spending rate, cost of revenue, been pretty much same rate, close to the same range. It is a touch higher than the previous quarter, but that's no problem. R&D spending been also pretty stable here at about 20% or so. And then you have marketing. Yes, the increased marketing spending used to be negative in 24, went higher to 7.5 in Q1 25. Now they've accelerated this marketing campaign by increasing spending on marketing by 23% year on year. But at the same time, they're cutting a ton of the G&A cost. And they've been doing that for a while now. In the latest reading, G&A cost went down by 27% or so. That is a slightly less impressive rate from the previous quarter when it was down by 34%, and the quarter before was down by about 67%. So Meta's secret in increasing their capex, but still managing to be profitable, is they're cutting G&A expenses in a big way. Where's that coming from, by the way? Maybe they're reducing a lot of headcount, reducing a lot of employees. You look at the headcount growth going back to Q3 24 all the way to the most recent quarter. We see positive headcount growth, 7% in the recent quarter. Of course, it's a lower rate than the previous 3 quarters, and that explains the reduction in G&A expenses. When you look at the headcount, it went down by about 1,000 employees from Q1 to Q2. Now, reducing billions of dollars in G&A costs coming from 1,000 employees losing their job, maybe they're cutting in other places too. But my hunch is they're firing a lot of senior engineers. Let's say employees who get paid a lot. They're cutting a lot of those. Maybe these engineers are developing AI, and then Meta says, okay, well, you did develop AI, now AI took your job. Goodbye. We don't need you anymore. That is the secret behind Meta being profitable despite the massive increase in capex. Now, of course, there are limitations how much they can continue to reduce G&A expenses. At some point, that rate will go flattish, will go positive. They're going to begin to spend more again year on year. The law of numbers, law of large numbers, law of small numbers. That's going to catch up sooner than later. And then you're not going to see numbers of profitability as impressive as we've seen right now. Okay, so far, what is the catch with Meta? I'm trying to dig here and find anything to hate in this report. Maybe you'd say, Mav, the advertising revenue is highly cyclical and we have weakness in the economy. I'm betting that advertising revenue growth is decelerating. Not really. If you look at advertising revenue alone, it's up about 21.5% in the most recent quarter. So that's an improvement from the previous quarter of about 17.5%. There's no problem here, at least not yet. Now you might say maybe they're spending, overspending like a drunken sailor because Zucchini is obsessed with the glasses and the stupid stuff. If you look at Reality Labs, this is the name of the segment for the VR and the glasses and the metaverse and the stupid stuff. When you look at the loss, because it's a losing segment, it's a new segment, they lose money. But look at the reduction of the rate of growth in the losses from this segment. It used to be in Q3 24, the income from Reality Labs, down 18% plus. Now, in the most recent quarter, fractionally down, not even 1%. So the loss is about 1% year on year. So here, they're also doing pretty good. Okay, maybe it's the valuation map. There's no way that Meta is not overvalued right now. If you look at the PE ratios, maybe. I don't look at those. I look at my own formula. If we do that, we go to H1 2025. Beginning of the year, all the way to June. That includes, of course, Q1 and Q2. So if you look at the revenue growth year on year for the first half of the year, it's 19%. If you look at the operational income growth year on year for the first half of the year, about 32.5%. Now, the stock during the same period was up by about 25%. So at the price that the stock was trading at by the end of June, it was pricing in the revenue growth, but not pricing in the operating income growth. It depends from case to case, folks. If you have a growth company that is not profitable, what matters is the revenue growth. That's what the stock is trying to predict. But in certain companies that are large and they produce numbers and profits like this, both are important, the top and the bottom line. Some folks would take the average rate of growth between revenue and operating income and judge based on that. But what if the stock right now cares about the profitability of Meta? Because that's the most impressive aspect of it all. At the closing price, by the month of June, the stock was underpricing the performance that we have in operating income. You look at the closing price of today, that's the year-to-date performance. The stock growth is actually up 18.75%. So meeting the revenue growth, but way underpricing the profitability of the company at the same period of time. So suppose that Meta wants to price in the growth in operating income for the first half of the year, and the stock growth year to date has to be 32.5% or more, because now we begin to predict what's going to happen in Q3. If that is the case, and we just go to the rate of growth of operating income in the first half of the year, about 32.5%, if the stock has to go year to date about 32.5%, then the stock price should be at about $782 a share. What is Meta doing after the bell? It is trading at about $775. So in this case, according to the Maverick formula, Meta was undervalued. Now, if we get to a point where we see the rate of growth going negative or slowing down, that's when you begin to see the stock performing negatively. So when we see such performance by Meta, what does that say about the stage of the bubble that we're in AI? It says that when it comes to B2B, we're not close to the peak yet. B2C, maybe. And that's going to be evident by Apple and Amazon results in tomorrow's session. But based on Microsoft and Meta, the B2B aspect in the AI bubble, at least from the big cap, large technology corporations perspective, we still have plenty of room for growth. Now, of course, at some point, maybe the damage in the economy is going to catch up with them, but it's not doing much right now. We had a trade on Meta, so we've done the same thing. What if Meta reacts flattish? Let's get some premium, and we've done an iron butterfly, 695 puts, 695 calls. Those are the ones that we sold. Then we picked the stop loss at about a 10 delta. So we bought the 7.5 calls and the 685 puts. The expiration date is this Friday. There's a mistake right here. It shows the 8th, but it is for this Friday. That was specified in the description of the lotto. Now, I've updated you and opened individually because I made the mistake of opening for next week. Then I had to redo it for this week. And I actually got paid to trade. I got paid more than my risk. So if you do the iron butterfly, the same strikes that I showed you, 695, and you buy the 705, and that's the calls, of course, and the 685 puts, I raised over $10 in credit, which means that I covered for my max loss. I'm playing with the house money now. If Meta acts flattish, I'm going to collect a nice premium. If Meta pops significantly higher, I'm not going to lose anything because I'm playing with the house money. So I managed to outsmart the market maker. How did I do that? This is what it looks like. I bought Meta, the 705 calls, the expiration date this Friday. That was around half an hour before the close. I paid about $16.30 a piece. Then minutes later, I opened the 585 puts, the same expiration date of this Friday, and I paid $15.50 a piece on those. So all in all, to buy the 685 puts and the 705 calls for the expiration date of this week, I paid about $31.08 a piece. Now, after that, I sold, here it is, sold Meta 695 calls, same expiration date, and I got $22.05 a piece. Then minutes later, I sold the Meta 695 puts. That's, of course, the body of the iron butterfly. Same expiration date, this Friday, and I got a premium of $20.45 a piece. So the premium that I collected was $42.50 a pop. I paid for the calls and the puts, $31.8. So all in all, I received credit of $10.07 a piece. My maximum loss is 10, so I'm up 7 cents either way. Win or lose, I get to capture 70 cents for free. You're not going to find a lot of examples where this kind of trade works out this way, but you have to consider it. We have plenty of earnings. And before the reports are out, you want to look at these tickers and look at the iron butterfly for the weekly expiration date. see if you can get enough credit that could cover for whatever delta gap that you have in the trade. So if your max loss is 10, can you raise 950? The risk versus reward now is worth it because your max loss is 50. Can you raise more than 10? Sometimes you can do that if you open them separately, as I showed you. And if you can manage to do that and raise more than your max loss, you're playing for free. And if the stock reacts flat, you collect the premium. So you always have to consider that. But don't feel too good for me because what if Meta goes in an erratic move as we've seen? I did not do the double calendar as I did in Microsoft because I was only interested in a trade if Meta crashes down. So I did buy the calendar put spread, the 625 puts. Bought next week and I sold this week. Cost me about $1 a piece. So all in all, I got the credit, $10.7. So I'm going to collect about 70 cents. And my loss from this trade right here is $1. So all in all, my max loss is 30 cents. I'm not going to make any money from it, but I'm proud of myself that I managed to beat the market maker. Anyhow, let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices, and here we go. The diamonds in the red, down by 171.71 points, or a loss of 0.38%. The Nasdaq flattish, be it positive, 31.38 points, or a gain of 0.15%. Of course, the Nasdaq is going to be the winner in tomorrow's session. What about the S&P? In the red today, down by 7.96 points, or a gain of 0.12%. Again, the expectations, S&P probably going to be positive, based on Microsoft and Meta up about 7% apiece. That's going to do it. What about the leading indicator, though? It's down today, and it might lag tomorrow. It's down 1.13 points, or a loss of 0.51%. Why would it lag? Because the Russell 2000 thrives when we have bets on rate cuts. And right now, we don't have those. Powell reduced the odds for a rate cut in September. Maybe we're not going to have a rate cut for the remainder of the year. If that is the case, Russell 2000 is not the place you want to be in. And you're probably going to begin to see the speculative names, the high beta names, profitless names getting dumped. And when you have a company like Meta reporting a decent report like this, you're going to see a lot of investors and traders migrating back to these big cap companies. Of course, awaiting Apple and Amazon, because those are important too. We want to see the contrast between B2B and then B2C. If B2C is bad, but B2B is okay, you're going to see a lot of migration back to where the growth is. When we look at these sectors, utilities at number one, followed by tech and comm services, but it was a flattish day, slightly negative, led by metals because we got the copper tariffs, a clarification on it. We'll talk about that in the commodities segment, but rest of the market all in the red. Looking at the breadth, not looking pretty good here, negative again. The NYSE 24% advancing, 75% declining. The Nasdaq 30% advancing, 67% declining. So we have two negative sessions in a row. For the market maker to win at the end of the week, they need at least one positive breadth kind of session before the end of the week. And that could happen in tomorrow's session, since we have Microsoft and Meta up 7%. That's probably going to do it. When we look at the map again, you have the dollar going higher. You have interest rates also going higher. That's going to be bad for the majority of the components of the map. So you see the majority of the map is in the red. We have some exceptions. We have rebounds in the healthcare insurer names, like United Health and such, but these are rebounds to sell. You don't want to get engaged in the health insurance names. We see some earnings pops, such as, for example, in defensives, you have the ticker MO. You have certain names that reported earnings going higher. But the majority of the map, the vast majority is down. The only segments that are doing pretty good are the AI segments. Not all of them, though. It's the big names, NVIDIA, AVGO, where we don't have feedback yet. And it's the data center energy providers, such as in utilities, Constellation Energy, Vestra VST, and of course in industrials you have GEV, GE Vernova. Those are going higher. But besides that, the market is negative across the board. Now the picture is going to change in tomorrow's session. You're going to see a little bit more optimism about the AI spending. It's going to be led, of course, by Microsoft and Meta. You're probably going to see NVIDIA again in the green, and you might see some other names also benefiting. But keep in mind that we also got Qualcomm after the bell. We got Lam Research. Both of these names are down big. So we have a little bit of divergence beginning to show up in the performance of these chip AI stocks. And if we continue to see weakness in the chips as we get more reports to come, we're going to begin to migrate toward the software side of AI, because that's what's leading the growth in Meta. That's what's leading the growth in Microsoft. But the physical, the hardware, the chips, maybe that's already overstocked. And now you only got China to sell to. We're talking about NVIDIA, of course. They say that we have a supply shortage right now, so we'll see what happens with NVIDIA. But the game might change in AI. And investors' concentration might shift toward, look, what we expect from AI is improvement in the top and the bottom lines. We're not going to see improvement in the top lines. That's going to take years to come. But what if we see efficiency? That AI is reducing headcount, for example, and the bottom lines are improving in these companies, as we've seen with both Microsoft and Meta. The investors are probably going to migrate and gravitate toward where the profits are. And if it's not showing up in names like NVIDIA, I expect the profitability to be squeezed in NVIDIA. Then we're going to see an efficiency rush, where folks are just chasing efficiency based on AI. Keep that in mind. Moving on to commodities, huge moves today. So we talked about crude oil because of the Russian sanctions. Expectations, demand will go higher for WTI and Brent. Don't forget that oil loves the dollar going higher. So for those reasons, we see the WTI and Brent heading higher, along with them the gasoline RBOB. But we see pullbacks in diesel and pullback in nat gas. When it comes to softs, the biggest loser is OJ, down about 6%. It benefited a lot from the tariffs from Brazil. So what happened today? What happened is taco. So all of that barking, now Trump hits Brazil with 50% tariff. But excluding aircraft, OJ, and energy. Well, these are the top imports that we get from Brazil. If you watched the video that I produced a couple of weeks ago, the title is America's Worst Economic Nightmare, the alliance between Brazil and China. So this is more of a bark, not a bite, because you're excluding the most important commodities that come from Brazil. And this is why OJ's down. Now, the metals were getting hammered to begin with because the dollar was going higher, and Powell firmed up the rally in the dollar. But add on that, you see copper down about 17-18%, huge drop in copper, a crash. What the hell happened? What happened is a taco. So now we got a scaled back copper tariff. In the beginning, President Taco said that he's going to do 50% tariffs on copper. But as I explained to you before, we have no refiners. The refiners are in China. So even if we mine the copper here in the U.S., we're going to have to send it to China and then have it back, shipped back. And is that going to be subject to a 50% tariff? It doesn't make sense. And maybe somebody told him that we cannot really improve the refining capacity here. So he decided to say, okay, let's do 50% tariffs on copper wires and copper pipes. We're not going to tariff refinished copper. You can bring in copper anywhere you'd like to bring it from. And that's not going to be subject to the tariff. And hence we see the premium that we got in U.S. copper being reduced and catching up perhaps with the LME, the London copper. But with that being said, the reaction is so excessive and it reeks of algorithmic reaction, algorithmic panic, because folks set stop losses and all of these stop loss orders got hit. So here's what I would say. I would say the dip in copper, opportunity to buy, but when will it formalize? Once the dollar is done rebounding. Do we have a catalyst this week that could stop the rebound in the dollar? Yes, we do have the jobs number coming out Friday. If that comes out soft, you might see the dollar heading down, and you might see finally the bottom and the rebound in the metals that got sold, be it gold, be it silver, be it platinum, be it copper, be it palladium, be it steel. All of them are going to rebound, but you got to wait for that signal when you see the dollar done rebounding. Moving on to the big casino options, what can we see here? And by the way, believe it or not, 70 to 80% of the market's volume these days is guided via 0 DTE's options. Not just in the indices, even in the big names like NVIDIA. They trade the weekly expiration intraday, meaning they enter in the beginning of the day, they exit before the close. Lather, rinse, repeat. So if you think the market is a casino, it is literally a casino right now. But our job is to spot the opportunities. And where can we spot some opportunities? Of course, NVIDIA comes to mind. Volume is high, but the implied volatility is low, yet it is increasing. So yes, NVIDIA might be moving higher, but you want to consider grabbing puts on it, especially if you're a shareholder, because we have earnings coming out at the end of the month of August. And the implied volatility right now was suppressed, was almost zero just a few days ago. Now we're up in the IV rank to 20%, meaning the premiums, the pricing of the premiums is going higher. Now, it wouldn't help you, of course, if you buy a put right now. Let's say you buy the 180 put, and then you see NVIDIA in the next day up 5%. Of course, you're not going to make money just from the increase of the implied volatility alone. But if you have enough time for the trade, any bad news that would drop the stock down with increase in implied volatility will appreciate the values of these premiums that you got significantly. So you got to consider buying some puts in NVIDIA here if you're a trader, but most importantly, if you're a shareholder. Tesla is another great opportunity right now. I don't care if you want to bet calls, puts, doesn't matter to me. But the IV rank right now, the cheapest going back a full year. The IV rank is at 0. So these are the cheapest options we've seen in Tesla. Another one that stands out is, of course, AMD. We have the IV percentile at 84. The stock keeps going higher, so it means that we're getting really close to a stall or a correction before the earnings report next week. Let's do the unusual activities, beginning with GLD. Here it is, bullish call for GLD. Somebody buying the dip already. They bought the 310 calls and they sold the 350 calls. The expiration date is December 19th, 2025. In what is known as a bull call spread. Right now, GLD trading at about 301. They spent about $2 million here. Then we got Eli Lilly, of course, with the bad news that we got from Novo. Somebody's betting for a pop once Eli Lilly reports earnings, I believe, in a week or so. The stock right now trading at about 770. They bought the 850 calls. They financed that by selling the 900 calls. What is known as a bull call spread again. The expiration date is really near. August 22nd, so this is an earnings play. Spending about $1 million. Now, you look at this chart right here, Eli Lilly. It's a big pop to 850. They bought 850. They sold 900. And the expiration date is in less than a month. So there are expectations of a big pop once we get the earnings report. How do I play this? Because maybe they know something that I don't. Maybe this is an insider. Before the earnings report, let's say a day or in the same day, I would buy call exposure, be it naked, be it calendar, whatever we decide at that point. Then I got another one for you here for ANET, A-N-E-T, Arista Networks. The stock is trading at about 122 right now, but they bought the 125, that's the main trade, 125 calls, and they added a booster to it by buying the 140 calls. The expiration date, November 21st, 2025. Now the main is 125, but what if there's an explosive move higher? They want a booster, so the booster is the 140 because it costs you less. And all in all, spending about $12 million. Got another bullish one for you here for the IEF. Now this is the 7 to 10 year T-bond. So they're betting on the belly of the curve. And when they buy calls on the bond, they're betting that the yield will go down. And they're spending a lot of money on it. So there is a reason why they're doing this. They bought the 97 calls along with the 102 calls. The expiration date is December 19, 2025. Spending about $5.5 million. Maybe what they're betting on is now that Powell came out hawkish, we will see the long and the short end of the yield curve moving higher, but the belly going down. What is known as a U-shaped yield curve. Maybe. That's what they're betting on. How about another bullish one for you for EL, Estée Lauder? I'm still long EL, and it's been doing pretty good. Somebody sees more gains to come. Stock trading at about 93, 94. They bought the 95 calls for September 19th, 2025. Spending about $2 million. Let's do the bearish ones because we have another mega one. It seems to me that this is the same trader who opened, was it $92 million against the Qs yesterday? Somebody here doing the same structure. The diagonal put spread on the SPY this time around. They bought the 585 puts for the expiration date of March 20, 2026. They financed that by selling the 560 puts with the expiration date of December 19th. Mind you, right now the SPY is trading about 635. By tomorrow's open, it might be 640. So they're betting on a steep drop here by March of next year. And all in all, spending about a little over $1 million. Huge. My 2 cents? This could be a hedge fund. It could be the big short Michael Burry. It could be somebody who's betting against the market. And they bought a diagonal put spread on the NASDAQ yesterday, and now they're buying a diagonal put spread on the SPY. And each one of them cost about $100 million. Got another one for you here against the index, the E-mini futures this time around, the September contract. We're trading about 6,400 right now. Somebody buying in the money, or at the money, close at least, close to the money. The 6,400 puts, the expiration date is August 29, 2025. See, this one looks like a hedge because it is pretty much at the money, and they're buying the quantity that they need for the hedge, spending about $1.5 million. Let's do some charts, and before we begin, folks, we're going to keep it simple here and short because, be honest with you, a lot of you are making a major mistake. A lot of you are looking at the charts and you're looking at the technical patterns or bull flag, wedge, a double bottom, double top, and you're getting it wrong either way, because this is not a technical market at all, at least not right now. It is a mechanical market, and this is what I try to teach every day. You can look at the charts and do the technical analysis, but you have to do the mechanical analysis too. You have to be able to look at the options market data and be able to read that too, because right now it is a market driven by the mechanics, aka the options. Maybe it's going to change down the line, but now this is the market what we got. So we're going to keep it brief here in the technical analysis. We don't want to waste a lot of time on it. So let's begin with the E-mini futures daily chart. What can we see here? We were anticipating a visit to 6,350. We got close enough today, real close, and now we have a rebound based on Meta and Microsoft's earnings. Can we make and close above the highs from Monday or not? That's going to be an important question in tomorrow's session. Closing above opens the path for more gains to come. Reversing before that, then we're probably going to have a clean revisit to 6,350. And that could be based on Apple and Amazon disappointing, for example. Any problem with the IWM daily chart? Not really, not until we lose the 200 days moving average. If we close below that, then okay. We got a reversal sign across the board. Dixie daily chart. We have the inverse head and shoulder broken above the resistance and now accelerating higher. I would say we might meet the next resistance, which is at about 100 and 540 basis points, which means the dollar might have more gains before maybe, keyword maybe, the jobs number on Friday might put a stop to it. In the meantime, we've been talking about this for weeks, folks. You can go back 2 weeks. And I've been saying you have to understand that there is risk that the dollar is going to rebound, specifically after the FOMC. We'll be talking about this for days now. So hedge your metals portfolio. I'm surprised that some of you today in Discord saying, hey, Mav, what should I do with my lithium or my copper or my steel or gold? We've been saying hedge for weeks now, folks. Anyways, for now, we still have maybe more juice to go here in the dollar all the way to 100, 540 basis points. And if that is the case, you might see another pullback in gold futures. But right now, I mean, gold is steady Eddie. Nobody's going to dump gold or panic dump gold. Folks who are buying gold are buying for a really, really long time as a major hold. So I don't anticipate major weakness in the dollar, or excuse me, in gold, as the dollar begins to rebound and continues to rebound. Now, we might go to the hedge zone, which is 3,250. If we break that, then we need to hedge. But so long as we're above, it's just a pullback. You can make a tiny hedge on it by buying weekly expiration dates, puts on the SLV silver or the GDX gold miners. I'd be worried more about copper than gold because this is a massive drop that we see right now, losing the 200 days moving average. Exaggerated? Yes, I think so. And now we have a double whammy. We have the algos dumping based on the tariff news. And we also have the dollar going higher. What I would hope for is copper going down all the way to revisit the recent lows right here at around 4.25. If that is the case, we begin to find some footing and the dollar begins to move down. I'll be buying with both hands. Feet might be involved too. When it comes to crude oil, of course, it's going to be doing pretty good along with the dollar. And right now facing a little bit of resistance here at 70. But if the dollar has another leg higher, you're probably going to see crude breaking above 70. The Big Kahuna Apple 2 hours chart, what can we see here? We lost 210, but we haven't lost 207.5. This is going to be an earnings game, and you're probably going to see a little bit of rebounding before the report comes out, because maybe somebody shorted today, they made money, and they don't want to hold and assume the risk all the way till the report comes out. So they're probably going to cover a little bit, then up to the earnings, good or bad. We'll see what happens. NVIDIA, stopping pretty much at the highs of yesterday's session. We can argue this is a bull flag, but again, you could argue that this was a bear flag and this one too, but didn't work out. And the reason is we're not in a technical market anymore. We are in a mechanical market. And if you have hundreds of thousands worth of contract volumes being traded in out-of-the-money calls for weekly expiration, it's going to squeeze the market maker to buy shares in NVIDIA and push it higher. And right now they're aiming for 180, and probably in tomorrow's session they're going to aim for 185 and then 190. Until that game stops, NVIDIA can theoretically continue to go higher. But I anticipate Meta and perhaps Microsoft's earnings, when you dig down to it, folks might notice that the spending is now not happening in chips anymore. And that could be a net negative for NVIDIA. What about the souffle 2 hours chart for Tesla? Reached the support, 313, let's call it 313 even. I have it at 313.30, but we're not going to make a big deal about the 30 cents here. Now, if we lose it, if we close below 313, I would say the next stop would be 300. BTC tulips, what do we see here? No move, nothing, no change at all, just gathering some energy. There's a big move coming, of course, but it requires a break one way or the other. Give me a close above 120,000, I'll be buying calls. Give me a close below 116, I'll be buying puts on it. Let's move on to the conclusion of this video. What do we have in the economic calendar tomorrow? We got the initial jobless claims. That's going to be important, of course, if there is something that is an outlier. Then we have the PCE index. Now, again, PCE is going to be lagging, so we expect that inflation is going to go a tick, just like the CPI and the PPI showed, but I don't expect a big market move based on the PCE. Of course, Powell already knows what the PCE looks like, and he decided not to cut rates. So it's probably going to come in the hotter side, but just a touch. Then we got the Chicago Business Barometer, known as the PMI. The most interesting action, though, is going to happen in the earnings calendar. Two giants, Apple and Amazon, after the bell. And again, this is the AI side of B2C. B2B is doing good, but B2C, consumer weakness, interesting to see. And of course, a pulse on the consumer is going to be MasterCard. That's going to come out in the morning. We have other important names such as FV and Stryker Corporation. You have Comcast, MicroStrategy. All of these names are going to report in tomorrow's session. So we have an interesting day ahead. Let's call it a night here, folks. Take a rest and come back tomorrow. So this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.